People talk about rental properties and Airbnb properties. They talk about flipping houses. They talk about syndications. But you know what people don't ever talk about? They don't ever talk about how to invest in with $5,000 in those investments instead of the typical 50 to 100,000.
Is that even possible? People don't even realize that's a thing.
Exactly. And that's why no one talks about it, is that most people don't realize that they can do that, much less how that works. And even if they do understand at a very high level how they could invest with 5,000 or 2,500 or 10,000 in these types of real estate investments, they still don't execute on it because they don't know how to actually go through that execution process. So we're going to cover both of those things today, both the concepts behind it and how to execute on it. So on that note, welcome to the Bucks Outside the Box show, where we challenge conventional money advice. We get a little contrarian. We talk a little real estate, and we try to think, well, outside the box. There you go. So let's start with the foundation here. Denny, how much does it normally cost to invest in real estate?
You need your down payment, closing costs, possible repairs, so 50 to 100,000.
That's right. And so that's if you are an active investor, you're going out and buying properties yourself, you're looking at normally $50,000 to $100,000. Now, there are ways that you can get around that, of course, but it requires you to jump through a lot of hoops with, negotiating seller financing, or like a seller held second mortgage. You can get around some of that stuff, but it requires you to jump through some hoops, and there's no guarantees to it. If you're investing passively in syndications, or doing like a silent partnership, or investing in a fund, whether that's a real estate equity fund or a debt fund, you're also looking at a minimum investment of typically $50,000 to $100,000, depending on the investment. And that's the minimum that the operator will accept from you. And they say that, say, here's our syndication and the minimum investment is 75,000 or, whatever. And that makes it hard to invest regularly, right? I mean, most of us don't have 50,000, 75,000, 100,000 just sitting around collecting dust. Take some time for a normal person to save that up. So they're not able to invest regularly.
How do we invest with smaller amounts? How do we do this?
Well, I'm glad you asked, Denny. So the simple answer here is that you go in on real estate investments with other people, right? You go in on these with other investors so that each person can invest a smaller amount. So that's a simple concept, but it's not easy to do in practice, right? In fact, it's quite hard to do in practice. So types of investments here that we're going to particularly cover today are, JV partnerships, joint venture partnerships, syndications, private notes, and private funds. Again, that could be equity funds, it could be debt funds. But, these types of partnerships, again, typical minimum is 50 to 100 grand, but you can go in on them with other people. And the easiest way to do that is to join an investment club that specializes in these types of investments. So we actually, spoiler alert, we happen to run such an investment club, right? It's called the Co-Investing Club. You can look at other ideas as well, and you can start your own. And we'll talk about that in a few minutes as well. But there are a lot of advantages to investing in real estate as part of an investment club. One is that you invest a lot less of your own money, of course. We already covered that. You can invest with $2,500, $5,000, which is a much more manageable sum than 50 or 100,000, right?
And it helps with risk big time.
Right. You spread out your investments. So you spread out your risk across you're having small amounts across many more investments. So your returns over time, they form a bell curve, right? So a few of those investments are going to underperform. A few of those investments are going to overperform. Most will be somewhere in the middle of the bell curve. And that's just a lower stress way of investing than plopping 100 grand down in a single property or a single investment. You also reduce risk by analyzing investments alongside other investors, right? You get the benefit of all of their knowledge and experience as well. So in our co-investing club, for example, once or twice a month, we meet on a big Zoom call. We bring the operator in, the real estate operator in, and all of our club members get on this call and we all grill the operator with questions together. So we're all analyzing risk together with these deals. And then we kick the operator off the call and we have an internal discussion about it. What do we like about the deal? Where do we see as the risks in the deal? Any concerns that we might have? But analyzing investments together alongside a whole bunch of other investors does
with
help reduce
completely different backgrounds. I mean, financial experts and even
insurance.
construction
Yep,
experts that
construction
will
and too.
ask things that I would never even think.
Exactly. So, you have a collective mind, basically, a collective experience level that you benefit from as an individual investor. You also have steady deal flow, right? I mean, 1 to 2 deals every month coming in your inbox that you can look at with other investors in the club, right? And analyze together. So there's a steady deal flow. You're not out there trying to hunt these down on your own and figure out, which operator should I look at and, how do I vet them? Going that alone is a lot more work and it's hard, right? So steady deal flow is another benefit of going into these alongside other investors in an investment. And when you can invest small amounts like 2,500, like 5,000, you can practice dollar cost averaging, where you're just investing slowly and steadily every single month or every other month or every quarter or, whatever's comfortable for you. But you can do that, slowly, steadily, consistently. And that's the important thing here. You're not trying to time the market with that $100,000 investment that you make once every 18 months or whatever. You're just doing it month in or month out or, every quarter or whatever, but you're doing it consistently. And that way, over time, you are not subject to the same market risk of investing right before a big crash or something, right? Like plopping 100 grand into an investment right before something goes terribly wrong. It's just that slow and steady investing. And over time, you're going to do well with that, as property values go up, as you enjoy the cash flow from the investments, as you enjoy the tax benefits, as you enjoy, the debt pay down on these real estate investments. So
So
dollar
less
cost.
nail biting.
Exactly. Exactly. And because you are investing consistently, you can do the lazy 1031 exchange strategy, where as your older investments are selling off and, paying out your profits from them, you are continuing to invest in new investments and getting the big tax write-offs from some of these investments. Not all of them come with tax benefits, but
Right.
some of them do. So most syndications come with great tax write-offs in the first year or two. You get a big deduction there from depreciation, which you can use to offset the profits from the last one that just sold, or cash flow from your other ones, or even dividends from stocks or capital gains from stocks. You can offset those older investments and their returns
Why
with
is it called lazy?
because you don't have to go through the full 1031 exchange process with hiring a qualified intermediary to hold your money and, identifying the new investment within a certain number of days and then settling on the new property within a certain number of days. You don't have to do any of that stuff. You just have to invest in a new investment with those tax benefits, the big depreciation write-off, and to invest in that within the same calendar year as the other stuff, right? So that it's included on your tax return. So it's a great way to reduce your tax bill. Also, avoid liability risk when you are investing in passive real estate investments. You can't be sued. Whereas when you're a landlord, when you're an active investor, you can and will be sued sooner or later, right? I mean, you and I have both been there. You and I have both been landlords. We've both been
I
sued.
used to get so afraid of
Yeah,
that. That was a big
it's
fear of mine.
terrifying. It's very scary. Absolutely. And they're coming after not just the property, but they're coming after your personal assets too. They will name you
Right.
personally in the suit, even if you own the property under an LLC name or another entity name. And it's up to you to try to convince the judge to remove you being named personally in the suit from it. And you have to prove that you manage that property completely as a business, completely separate finances in every regard. So even if you own properties under a business entity name, that does not make you immune to being named personally in the lawsuit.
And then if you're investing in a tenant-friendly state, we won't even go there.
Right. And you also avoid debt liability. So not just the legal liability from lawsuits, but you also avoid debt liability by investing passively. When you take out a mortgage or a hard money loan or a portfolio loan or any other type of financing for an investment property, you're signing on the dotted line with a personal guarantee. So if you default on that loan, the lender can come after your personal assets, not just the property, right? So there is some of that more personal liability there that you don't have when you're investing passively. And finally, what's the final advantage to going on some of these passive investments with other investors?
I don't have to be bothered by tenants while I'm food shopping.
Yes, exactly. Which I know you have been, by the way, at the grocery store. And not just bothered by tenants, but hassling with contractors and repairs. dealing with city inspectors, dealing with property
Oh,
managers. Yeah, I mean, the list goes on and on and on. Landlording or, flipping houses or, any kinds of active investing, it's a business. It's a side hustle or a full-time business. And there's nothing wrong with it as a business model, but it is a business model, right? Like it's a business and it requires work from you. It requires labor.
and
Well,
time and aggravation. People don't often put that in there.
right, exactly. Rental income is not passive income. At best, it's semi-passive, but it's a side hustle. And again, nothing wrong with it as a side hustle if you are looking for a side hustle. I personally don't want a side hustle. I want to just write a check or send a wire and then collect the income in my bank account and have it just direct deposited in my account. So, yeah, when you invest
Hence,
passively,
passive investing.
exactly, exactly. So these are all reasons to invest passively in real estate alongside other people as part of an investment club like our co-investing club. The alternative here is that you could go and form your own investment club and do that heavy lifting yourself. It's a lot of work, right? It is heavy lifting. It's like herding cats, trying to get a whole bunch of other people to cough up thousands of dollars to invest in something that you happen to believe in yourself. So, wrangling all those other investors, forming a new LLC for each investment and figuring out who's going to pay for all of that. Get
Taxes?
Yep, yep. Filing a tax return for each LLC, having K1s or 1099s split up among all the different people in the LLC. This is all a lot of work. Finding new deals, right? The deal flow, identifying operators and deals that you want to invest in, and then convincing all your friends in your little investment club to actually cough up the money. This is a ton of work. It's a massive amount of work. You can do it 100%, or you can just plug into an existing investment club like ours. But that's your call. But these are ways to invest in 7-figure properties or 8-figure properties or 9-figure properties with $2,500, $5,000, $10,000, going in on these with other people, other investors through an investment club, whether ours or if you want to form your own, that's cool too. Denny, anything that we missed today? Anything you want to add before we call this episode complete?
I don't think so, Brian. I think that we covered it pretty good here.
Yeah. And guys, if you got a fresh perspective out of this episode, subscribe to the show. We're on here every week, and pass it along to friends, family members who could get a fresh perspective themselves out of it. And if you didn't get anything out of this episode, shoot us an email, support@sparkrental.com. Let us know what you want to hear more or less of. And lastly, consider joining us in the co-investing club. And if you want to learn more about passive investing, we do have a free course on it, free video course. Each video is very short and sweet, 5 to 10 minutes long. sparkrental.com/free is the free course URL. And on that note, stay weird, unconventional investor.